Ever wondered how to navigate the ups and downs of the stock market? Welcome to a world that never sleeps. The stock market, a dynamic and ever-changing landscape that can be as rewarding as it is challenging. At the heart of it all lies two key market conditions: bull and bear markets. A bull market is characterized by optimism, investor confidence, and expectations that strong results should continue. It's like a stampede of bulls charging ahead with unstoppable momentum. On the other hand, a bear market is marked by falling prices and typically shrouded in pessimism. The bear, with its hibernating habits, symbolizes a market in which most investors are pulling back or exiting their positions. Understanding these conditions and knowing how to adapt trading strategies accordingly can significantly improve trading outcomes. It's like learning to ride the waves instead of being swept away by them. By the end of this video, you'll have a better understanding of how to tailor your trading strategies to both bull and bear markets. First, let's delve into the characteristics of a bull market. Picture this: the market is vibrant and lively, filled with a buzz of optimism. That's a bull market for you, a condition where prices are rising or are expected to rise. The key features of a bull market are investor confidence and increased buying activities. Investors are hopeful, they're buying more, and this surge in demand pushes stock prices higher. Another characteristic of a bull market is economic recovery. A healthy, growing economy often fuels a bull market. Businesses are making money, unemployment is low, and consumers are spending. All these factors contribute to a positive market sentiment. But remember, a bull market isn't just about prices going up. It's about sustained growth over a period of time. It's not a sprint, it's more of a marathon. In a nutshell, a bull market is a trader's paradise, but it requires smart strategies to maximize profits. Now, what are some effective trading strategies for a bull market? A bull market, characterized by rising prices and investor confidence, offers several opportunities for traders to maximize their profits. One of the most common strategies is taking long positions. This essentially means buying stocks or other assets with the expectation that their price will rise over time. It's a straightforward approach that capitalizes on the upward momentum characteristic of bull markets. Another strategy to consider is buying on margin. This involves borrowing money to purchase more stocks than you could with just your available cash. When prices rise, as they tend to do in a bull market, the potential for returns can be significantly amplified. However, it's important to remember that this strategy also increases potential losses if the market turns, so it should be used judiciously and with a clear understanding of the risks involved. Options trading, specifically using call options, can also be an effective strategy in a bull market. A call option gives you the right, but not the obligation, to buy a stock at a specified price within a certain time frame. If you believe a stock's price will increase, you can buy a call option and potentially profit from the upward movement without having to pay the full price for the stock. This strategy allows you to leverage your position and potentially achieve higher returns. However, like all trading strategies, it comes with its own set of risks and should be used as part of a well-balanced and risk-managed portfolio. In all these strategies, it is crucial to conduct thorough market analysis and stay informed about market trends and movements. While bull markets generally trend upwards, they can also be volatile and unpredictable. Therefore, understanding market dynamics and being able to adapt your strategy to changing conditions is key. Remember, the goal in a bull market is to buy early and sell when the market reaches its peak. However, identifying the peak can be challenging, so it's important to have a plan and stick to it, adjusting as necessary based on market conditions and your personal risk tolerance. On the flip side, we have the bear market. But what does this mean? Well, a bear market is typically characterized by a condition where prices are falling, or there's an expectation for them to fall. It's like an icy winter for the stock market, where everything seems to be in a state of hibernation. Now, what are the key features of a bear market? The most prominent one is investor fear. As prices drop, fear sets in and often leads to panic selling. This fear is usually fueled by negative news and forecasts of economic downturn. Speaking of economic downturn, it's another key characteristic of a bear market. When the economy isn't doing well, unemployment rates rise, corporate profits fall, and that in turn leads to a decline in stock prices. And finally, there's increased selling activity. As investors try to cut their losses, selling pressures mount, causing stock prices to plummet even further. A bear market might seem daunting, but with the right strategies, there's potential to profit here too. So, how can a trader navigate a bear market effectively? Well, there are a few strategies that can be employed to not just survive, but potentially thrive during these challenging times. The first one is short selling. This strategy involves borrowing shares of a stock from a broker and selling those shares at the current market price. The goal is to buy back the shares at a lower price in the future, return them to the broker, and pocket the difference. It's a bit like turning the old adage of buy low, sell high on its head, as you're aiming to sell high, buy low. But remember, this strategy comes with risk. If the price of the stock increases instead of decreases, you could be in for a significant loss. Another strategy is buying put options. A put option gives the buyer the right but not the obligation to sell a stock at a predetermined price before a specific date. If you anticipate the price of a stock to fall, buying a put option could be a smart move. This way, even if the stock's price plummets, you can still sell it at the higher, predetermined price. But like all options, it's a gamble. If the stock's price doesn't fall as expected, the premium you paid for the option could be lost. Lastly, there's diversification. This means spreading your investments across various sectors, asset classes, or geographical regions to reduce risk. In a bear market, certain sectors might be hit harder than others. By diversifying your portfolio, you're not putting all your eggs in one basket, and thus you're better prepared to weather the storm. In essence, these strategies all rely on one fundamental principle. In a bear market, the aim is to sell high and buy low, or to profit from falling prices. It's about being proactive, not reactive, and making calculated decisions based on careful analysis and sound risk management. Navigating the stock market's ups and downs can be a challenging yet rewarding endeavor. As we've seen, bull markets, characterized by rising prices, favor strategies like taking long positions, while bear markets, with their declining trends, may call for short selling or diversification. Using options can provide additional flexibility in both scenarios, allowing traders to hedge risks or even profit from market volatility. Yet these strategies are not one-size-fits-all. Each requires a nuanced understanding of market conditions and a keen eye for risk management. In the constantly shifting landscape of the stock market, the ability to adapt is paramount. Analyzing market trends, staying informed, and adjusting strategies as needed will help you stay afloat and even thrive amidst the market's ebbs and flows. Remember, the stock market is not just about playing the game, it's about understanding the game. With these insights, you're better equipped to tackle both bull and bear markets. Happy trading!